You hear them all the time. GDP, inflation, unemployment. These are economic indicators, and they play a crucial role in our daily lives. They're like the gauges on your car's dashboard, providing essential information at a glance. Just like those gauges tell you how your car's doing, economic indicators tell us about the health of the economy, whether it's thriving or struggling. They help us understand where the economy is heading and how it might impact our lives, from job prospects to the cost of living. So, yeah, they're kind of a big deal. They influence everything from government policy to personal finance decisions. Think of it like this. Imagine trying to drive with your eyes closed. You'd be lost and probably in danger. That's what it's like trying to make decisions without understanding economic indicators. It's confusing and risky. These numbers give us a roadmap, helping us navigate the complexities of the economy, making informed choices. Whether you're a business owner planning for the future or an individual deciding whether to make a big purchase, understanding these indicators can give you a serious edge. They provide the insight needed to make smart, strategic decisions. GDP stands for Gross Domestic Product. It's the total value of all the goods and services produced within a country's borders in a specific period, typically a year. Think of it as the total income of a country, capturing the economic pulse of the nation. A growing GDP generally indicates a healthy economy, with more jobs and higher incomes, while a shrinking GDP can signal trouble, such as recession or economic downturn. For example, if the United States produces $20 trillion worth of goods and services in a year, that's its GDP. This includes everything from cars and computers to haircuts and healthcare, covering a wide range of economic activities. GDP is a broad measure encompassing all sectors of the economy, from agriculture to finance and everything in between. It's like taking the pulse of the nation's economic activity, providing a snapshot of its economic health and vitality. Remember when a candy bar cost a nickel? Yeah, me neither. That's inflation for you. It's the rate at which prices for goods and services increase over time. When inflation is high, your money buys less, eroding your purchasing power. Let's say a loaf of bread costs $2 today. If inflation is 2%, it might cost $2.04 next year. Seems small, right? But over time, it adds up, especially for things like housing, healthcare, and education. High inflation can be a real buzzkill, making it harder to afford the things you need and want. Section 4. Unemployment, the job market's report card. The unemployment rate tells us the percentage of people who are actively looking for work but can't find jobs. It's a key indicator of the health of the job market. High unemployment means fewer people are working, which can lead to lower economic output and slower growth. For example, if 10 million people are unemployed in a workforce of 100 million, the unemployment rate is 10%. When unemployment is low, it's generally a good sign. It means more people have jobs, are earning incomes, and contributing to the economy. Section 5. Why these numbers matter to you. Okay, so you get that these economic indicators are important for the economy as a whole. But how do they affect you personally? You might be wondering why you should care about these numbers. Well, they influence everything from interest rates on loans to the prices you pay at the grocery store. When inflation rises, the cost of everyday items like groceries and gas can increase, impacting your monthly budget. Understanding these indicators can help you make smarter financial decisions. For instance, knowing the trends in interest rates can guide you on when to take out a loan or refinance your mortgage. For example, if you know inflation is high, you might want to negotiate a raise or invest your money to outpace rising prices. This knowledge can help you protect your purchasing power. If you see the unemployment rate is low, it might be a good time to look for a new job or ask for a promotion. A strong job market can give you more leverage in your career. So, there you have it, a crash course in economic indicators. These numbers are not just abstract concepts, they have real-world implications. While they might seem complicated at first, understanding these basic measures can empower you to make more informed decisions about your personal finances, career, and overall well-being. By staying informed, you can better navigate the economic landscape and secure a more stable future for yourself and your family.